say that July is on the table here, and I think that it's very reasonable to think there's 2 cuts this year with this change in the dot plot. It's very clear that the Fed is really looking to ensure that the expansion continues, and it's positive for the market. I mean, this is what the market needed to see. The rates market is pricing this in, so this is all in sync. So pretty good. It's a good statement for the market.
I mean, we were saying that the Fed was going to walk a high wire act basically this afternoon here in terms of navigating the markets, and you know, the statement did it quite well in that it adopted the language that Jerome Powell used in a Chicago speech to really turn the markets around. And so that seems to satisfy the markets, at least for now. We do have sort of a positive bias to the markets, but still largely unchanged, David.
Well, that's, yeah, I think the stock market may like this in the short run, but I think we're in some dangerous territory here. I mean, first of all, two wrongs don't make a right. And it's inappropriate to have a overly easy monetary policy to enable an overly aggressive trade policy. Because what I hope people in Washington get.
By the way, do you think anyone on the Fed is actually trying to enable an aggressive trade policy?
I think the problem is the Fed has taken the position that monetary policy should be independent, and therefore they will not tell the administration what to do if the administration would please stop telling them what to do. Now, one part of them is, one side is keeping that agreement, but the danger here is that if they ease, the first thing is if they cut in July, everybody's going to expect them to cut again. 81% of the time, when the Fed cuts, they cut again within the next 6 months. So people will just build in a series of rate cuts, and as rates fall, people will expect, well, no, why don't I wait a while here, see if I can borrow at cheaper rates? It doesn't stimulate the economy, so there's a danger that they will actually make things worse by cutting rates in this environment.
John, would you agree with that? Because that, in a nutshell, is the case against an insurance cut.
Yeah, so the things that I would focus on here is I actually think that it was notable they didn't commit to July. There's nothing in here about a next meeting. There's nothing in here about, the G20. Of course, they're going to leave that out. So I think they're keeping their options open, and I think that is appropriate. They don't want to be seen as, doing anything that's going to interact with trade policy at the ex ante. Maybe after the fact they might, but I don't think they want to do that ex ante. The other thing I would focus on here is I do think we are seeing that movement towards concern about inflation. They've been talking about up to now about market expectations being low. But now they're saying they have declined. That's a change. That's something to focus on. And again, I think that's the way that they're going to justify a cut. They're never going to say that we're cutting because trade policy got too aggressive, to use David's words. But they will say, and I do think this is likely, they will say inflation's too low, we need to get it higher, and therefore we're going to ease policy. So what you're seeing today is you're seeing kind of the careful laying of the groundwork. They don't want to get caught up in the trade dispute. They don't want to get caught up in this meeting or that meeting, but they are carefully laying the groundwork for easing policy next year. Later this year. I think that's bond positive. I think that's equity positive, and we'll see how this plays out. But I think that's what they're doing here is they're laying that groundwork.
Bond positive, equity positive, win-win situation. Steve, what's your interpretation?
I think so far we've gotten what the market expected. I think it was clever and kind of classic of Powell to drop that phrase, will act as appropriate, in the June 4th or June 3rd Chicago speech, and then to repeat it in the statement. I think that's something the market can learn to rely on. It's a way that former chairmen have acted, and so now we can say that Powell is a guy who's going to drop these little hints along the way, and we can pick up on them and rely that they're going to end up being policy. So that's important. I still think there are some hurdles to a cut. And I don't know if you have that screen, guys, about how divided the Fed is, but you've got 8 on hold, 8 calling for a cut, 1 for a hike, and that's why you get an unchanged median for this year. We can talk about the math of the median if you like, but there it is, and that's the way I look at the median remains 2.4%. But, I've said all along, you have this Xi meeting coming up in Japan. You have the June employment report. You have the second quarter GDP before that, July. And to John's statement, they almost never would fully officially signal a change at the next meeting. They would drop hints along the way. And I think the data still have to cooperate, although I would say John is 100% right that the route by which they would do this is through the inflation route. The idea that inflation is now muted, the idea that it has declined, it's below the 2%. Be very interested to see in the upcoming press conference if Chairman Powell changes his tune about the nature of the decline in inflation being transitory. If that's the case, then I think you can take the cut in July to the bank.